Brazil is heading toward a fiscal crisis. President Lula is spending like money grows on trees. The deficit hit 9% of GDP in 2024, highest in Brazilian history outside of the pandemic, and there's no plan to stop. Social programs expanding, minimum wage rising faster than inflation, infrastructure spending accelerating, all financed by debt. Right now, Brazilian government bonds are in free fall. The real depreciated 20% against the dollar in 2024. Interest rates are back in double digits at 12%. Inflation is rising again after years of stability, and the bond market is screaming that Brazil is heading for crisis. The Central Bank of Brazil published data in December 2024 showing public debt at 89% of GDP. That's up from 75% in 2022. The trajectory is clear. Debt is rising fast. Revenue isn't keeping pace, and spending shows no signs of slowing. This spending explosion happened precisely when Lula returned to power in 2023 with a mandate to reduce inequality and expand social programs. The probability of sustaining this spending level without triggering debt crisis is approaching zero. This is the pattern of every fiscal crisis in emerging markets. Argentina in 2001, Turkey in 2018, Sri Lanka in 2022. Government spends beyond its means, finances deficits with debt. Debt becomes unsustainable. Market panics, currency collapses, crisis. Monica de Boll, senior fellow at the Peterson Institute for International Economics, stated in November 2024, Brazil is repeating the mistakes of its past. The fiscal framework that was supposed to anchor expectations is being violated. Markets are losing confidence, and Lula's government shows no willingness to make the hard choices necessary to avoid crisis. Even more alarming, Brazil's fiscal rules, the spending cap framework designed to limit expenditure growth, are being systematically violated. The government is using accounting tricks and off-budget spending to circumvent the limits. Markets see through this, and they're pricing in crisis risk. The assumption that Brazil had learned from past crises and built institutional safeguards broke completely when those safeguards are being ignored for political expedience. Here's what should terrify every Brazilian and every investor with exposure to Brazil. When fiscal crises hit emerging markets, they hit fast. Currency collapses 30 to 50% within months. Inflation spikes. Interest rates go to 20% or higher. Unemployment doubles, savings evaporate, and it takes years to recover. Think about that. Before we break down exactly how Brazil went from fiscal responsibility under previous administrations to runaway spending under Lula, why the spending is politically popular but economically unsustainable, what the bond market panic tells us about crisis timing, and what happens if Brazil can't stabilize before markets force adjustment. If you want to understand the most dangerous economic situation in Latin America right now, hit that subscribe button and turn on notifications. Because what we're revealing will change how you see Brazilian investments and why Latin America's largest economy might be heading for its worst crisis since the 1990s. Leave a comment. Can Brazil avoid fiscal crisis, or is it inevitable? Is Lula's spending justified by social needs or reckless? And what happens to regional stability if Brazil crashes? Let's start with the numbers because they reveal how fast the fiscal situation deteriorated. In 2019, before the pandemic, Brazil's primary deficit was 1.9% of GDP. That's the deficit before interest payments. Manageable. Not great, but not crisis level. In 2020, the deficit exploded to 9.5% because of pandemic emergency spending. Understandable. Every country ran huge deficits during COVID. In 2021 and 2022, under President Bolsonaro, the deficit came down to 0.9% and 1.2% respectively. Fiscal consolidation was happening. Debt was stabilizing. Then Lula won the 2023 election and took office in January 2023. The deficit immediately widened. 2.3% in 2023, then 9.1% in 2024. That's not pandemic emergency spending. That's structural fiscal deterioration. The primary balance, the government's surplus or deficit before interest payments, went from near balance to massive deficit in 2 years. And when you add interest payments, which are enormous because Brazil's debt costs are high, the total deficit is even worse. Interest payments are about 7% of GDP. So the total deficit including interest is approximately 16% of GDP. That means government spending exceeds revenue by 16%. They're borrowing 16 cents for every dollar spent. This is unsustainable. Public debt rose from 75% of GDP in 2022 to 89% in 2024. If this trajectory continues, debt hits 100% by 2027. At that level, markets typically refuse to finance deficits at any reasonable interest rate. The IMF projected in October 2024 that Brazil's debt to GDP will reach 105% by 2029 if current policies continue. That's Argentina territory, and we know how that ends. Now let's talk about where the spending is going, because it's not random, it's deliberate policy choices. Lula's core political base is workers and the poor. His mandate is reducing inequality, so he's expanding social programs that transfer income to lower-income Brazilians. Bolsa Familia, the flagship social program, was expanded. More families qualify. Payments increased. Cost went from 30 billion reais annually to 55 billion. Minimum wage increases are indexed to GDP growth plus inflation. So as the economy grows, minimum wage rises faster than prices. This sounds good politically, but it increases government costs because millions of public sector workers and retirees have incomes tied to minimum wage. A 10% minimum wage increase translates to 20 billion reais in additional government spending on salaries and pensions, and these increases are permanent, not one-time. Infrastructure investment is accelerating. Lula is funding new roads, ports, airports. The political logic is this creates jobs and stimulates growth. The economic problem is it's financed by borrowing, not by cutting other spending or raising revenue. The Growth Acceleration Program, PAC, has 200 trillion reais in planned investments over 4 years. About half is public sector, half is private sector with government incentives. But the public sector half, 100 billion reais, adds to deficits. Then there's the discretionary spending that always expands when fiscal rules are loose. Ministries hire more staff, agencies increase budgets, politicians fund pet projects in their districts to secure political support. Each spending item individually might seem justified. Social programs reduce poverty. Infrastructure investment boosts growth. Public sector employment provides services. But collectively, they're adding 8 to 9% of GDP to the deficit annually. And here's the political problem. Cutting any of these spending categories is politically costly. Cut Bolsa Familia, and you hurt the poorest Brazilians who are your voters. Cut minimum wage growth, and you face strikes and protests. Cut infrastructure, and you're accused of not caring about development. So politically, spending is easy to increase and hard to cut. This is the fiscal trap that emerging market democracies fall into. Now let's talk about the revenue side, because you might ask, why not just raise taxes to cover spending? Brazil already has a heavy tax burden. Total tax revenue is 33% of GDP. That's higher than the US at 26%. It's comparable to some European countries. The tax system is also regressive. Consumption taxes hit everyone. Income taxes on the wealthy are lower than they should be because of exemptions and loopholes. So there's political demand for tax reform that shifts burden to the rich. But tax reform is complex and slow. Lula's government proposed reforms, but they're stuck in Congress. Even if passed, they take years to implement and might not increase total revenue much. Raising taxes in a recession or slow growth environment is also economically damaging. Brazil's economy grew only 2% in 2024. If you raise taxes, you risk pushing growth negative. That reduces revenue even with higher tax rates. So the realistic revenue options are limited. Maybe you can squeeze another 1% of GDP from better tax enforcement and closing loopholes. But you can't close a 9% deficit with tax increases alone without destroying the economy. The math requires spending cuts, and spending cuts are politically unacceptable to Lula's government and coalition. This is why markets are panicking. The fiscal problem is obvious. The solution is clear. But the political system can't or won't implement the solution. Now let's talk about what's happening in bond markets, because this is where crisis risk shows up first. Brazilian government bonds, both domestic and international, are selling off. Yields are rising. That means bond prices are falling. Investors are demanding higher returns to compensate for increased risk. 10-year Brazilian government bond yields in reais went from 9% in early 2024 to 14% by December. That's a huge move. It means the market is pricing in much higher default risk or currency devaluation risk. Dollar-denominated Brazilian bonds are also selling off. The spread over U.S. Treasuries widened from 250 basis points to 400. That's the risk premium investors demand to hold Brazilian debt instead of safe U.S. debt. The currency is collapsing. The real went from 4.8 per dollar in early 2024 to 6.1 by December. 20% depreciation in 1 year. Currency weakness makes dollar-denominated debt more expensive to service and feeds inflation. Credit default swap spreads, which measure the cost of insuring against Brazilian default, spiked to levels not seen since 2020. This is the market saying default risk is rising. Foreign investors are pulling money out. Portfolio outflows from Brazilian stocks and bonds accelerated in the second half of 2024. Capital flight is a classic precursor to crisis. And this is all happening while global financial conditions are relatively stable. US interest rates are moderating. There's no global crisis forcing capital out of emerging markets. Brazil's problems are self-inflicted. When global conditions do deteriorate, and they will eventually, Brazil will be hit first and hardest because investors exit the most vulnerable countries first. Now let's talk about the central bank's dilemma because they're caught between inflation and recession. The Central Bank of Brazil raised interest rates from 10.75% in mid-2024 to 12% by December. They're trying to fight inflation and defend the currency. Higher interest rates attract foreign capital and support the real. They also slow inflation by reducing demand. Standard central bank response to fiscal crisis. But higher interest rates also increase the government's debt service costs. 7% of GDP goes to interest payments at current rates. If rates stay at 12% or go higher, interest costs rise to 8 or 9% of GDP. That worsens the deficit. This is the fiscal dominance problem. Monetary policy that's right for inflation and currency stability makes the fiscal crisis worse, and the central bank can't solve a fiscal problem with monetary policy. The central bank is also losing credibility. Lula publicly criticizes the bank for high interest rates. He appointed new board members sympathetic to lower rates. Markets worry that the bank's independence is being undermined. If the central bank cuts rates prematurely to reduce government debt service costs, inflation will accelerate and the currency will collapse. If they keep rates high, the economy slows and the fiscal deficit worsens. There's no good option. The central bank can buy time but can't prevent crisis unless fiscal policy changes. Now let's talk about the political economy of why Lula won't cut spending. Lula's political identity is as champion of the poor and workers. His entire career is built on expanding social programs and workers' rights. Cutting spending contradicts his political brand. His coalition in Congress depends on parties that benefit from government spending. The Centrão, the center-right bloc that provides votes, demands pork barrel spending for their districts. Cut spending and you lose their support. Lose their support and you can't govern. The left wing of Lula's own Workers' Party, PT, would rebel against austerity. They argue that social spending is morally necessary and economically beneficial. They blame fiscal problems on previous governments and wealthy tax evaders, not current spending. Lula himself is 80 years old. This is likely his last term. He wants a legacy of reducing inequality, not imposing austerity. So politically, he has no incentive to make painful cuts. The finance minister, Fernando Haddad, understands the fiscal problem. He's proposed mild spending restraint, but he's been overruled repeatedly by Lula. Haddad is implementing policies he knows are unsustainable because the president demands it. This is a government that's chosen to prioritize short-term political goals over long-term fiscal sustainability, and markets know it. Now let's talk about what crisis looks like if Brazil doesn't adjust. The most likely trigger is a currency crisis. The real continues falling, hits 7 per dollar, then 8. Then panic sets in. Investors rush to get money out. Capital controls are imposed, but it's too late. The real crashes to 10 or 12 per dollar. Import prices spike. Inflation goes from 5% to 15% or higher. People's savings lose purchasing power. Wages don't keep up. Living standards collapse. Interest rates spike to 20% or higher as the central bank desperately tries to defend the currency and fight inflation. This crashes the economy. Recession. Unemployment doubles from 8% to 16%. Government debt, denominated in reais, stays the same in nominal terms. But as a percentage of GDP, it explodes because GDP falls in dollar terms due to currency collapse and recession. Debt to GDP could hit 120% or higher. At that point, markets refuse to roll over maturing debt. The government faces a choice: default on bonds, impose a wealth tax, or go to the IMF for a bailout. Default is legally and politically difficult. It triggers lawsuits and cuts Brazil off from international capital markets for years. Wealth tax is politically explosive. Seizing part of people's savings to pay government debt causes capital flight and destroys what's left of investor confidence. IMF bailout requires austerity, spending cuts, tax increases, and policy reforms that Lula refused to implement voluntarily. but now implemented as conditions of emergency financing. None of these options are good. All are painful, and all could have been avoided with moderate spending restraint implemented earlier. This is the fiscal crisis playbook. It's happened in Argentina repeatedly, happened in Turkey in 2018, happening now in Egypt and Pakistan. Brazil is following the same path. Now let's talk about regional and global implications, because Brazil is not an isolated case. Brazil is 50% of South America's GDP. If Brazil crashes, the region goes into recession, trade collapses, regional currencies weaken, contagion spreads. Argentina is already in crisis. Add Brazil, and you have the two largest South American economies in simultaneous crisis. Chile, Colombia, Peru all face spillover through trade and financial linkages. China is Brazil's largest trading partner. Brazil exports soybeans, iron ore, oil. If Brazil's currency collapses, these exports become cheaper in dollar terms, but Brazilian purchasing power for imports collapses. China still gets commodities, but Brazil buys less Chinese manufactured goods. Trade imbalances shift. Commodity markets are affected. Brazil is a major exporter of agricultural commodities. Currency collapse makes exports cheaper. Supply increases. Global commodity prices fall. This hurts other commodity exporters in Africa and Asia. U.S. investors have exposure to Brazilian stocks and bonds, not huge compared to total U.S. portfolios, but enough that a Brazilian crisis shows up in emerging market funds and ETFs. Retail investors with EM exposure lose money. The broader concern is whether Brazil's crisis signals problems for other emerging markets. Is this a one-off due to Lula's policies? Or is it a symptom of global emerging market fiscal stress? Many emerging markets have high debt levels. Pakistan, Egypt, Tunisia, Kenya, Ghana, all facing fiscal problems. If Brazil, a much larger and supposedly more stable economy, has a crisis, it increases perceived risk for all emerging markets. That causes capital flight from the entire asset class. Emerging market bonds and stocks sell off. Currencies weaken. The whole sector suffers even if individual countries have better fundamentals than Brazil. Now let's talk about whether this is avoidable, because some argue Brazil can grow its way out of the fiscal problem. The optimistic case is Brazil's economy has strong fundamentals, large domestic market, abundant natural resources, diversified economy. If growth accelerates to 4% annually, tax revenue increases, and the deficit shrinks without spending cuts. The problem with this argument is Brazil hasn't sustained 4% growth for a decade. Structural problems limit growth. Poor infrastructure, low productivity, rigid labor markets, weak education system, bureaucracy. These problems don't get solved by more government spending. They require structural reforms that Lula's government isn't pursuing. So betting on growth to solve the fiscal problem is wishful thinking. Another argument is inflation will reduce the real value of debt. If inflation goes to 10% and nominal GDP growth is 12%, debt-to-GDP ratio stabilizes even with deficits. But high inflation destroys credibility and causes economic instability. It's not a sustainable solution, and it hurts the poor, Lula's core constituency, more than anyone. The realist assessment is Brazil needs spending cuts or tax increases totaling about 5% of GDP to stabilize debt. That's 100 billion reais. It requires cutting social programs, freezing public sector wages, and reducing infrastructure spending. Politically impossible for this government, So crisis is likely unless Lula changes course dramatically, and there's no sign he will. Now let's talk about what individuals should do, because if crisis hits, it will devastate savings and livelihoods. If you're Brazilian, reduce exposure to real denominated assets. The currency is going to weaken further. Hold dollars or other hard currencies, not in Brazilian banks if possible, because capital controls might freeze accounts. Move savings offshore if you can legally and practically do so. Dollar accounts in the US or Europe. Assets outside Brazil's jurisdiction. This protects against currency collapse and potential capital controls. Avoid Brazilian government bonds, obviously. They're going to lose value. Corporate bonds are risky too because recession hits companies. Real estate is complicated. Property values in reais might hold up or rise with inflation. But in dollar terms, they'll fall due to currency depreciation. And if there's recession, real estate liquidity dries up. Stocks are mixed. Some Brazilian companies earn revenue in dollars from exports. They benefit from currency weakness. Others are domestic-focused and get crushed by recession. You'd need to be selective. For foreign investors, the simple advice is avoid Brazil. The risk-reward is terrible. Even if you think crisis is only 50-50 probability, The downside is so large that you shouldn't take the risk unless you're getting paid enormous returns. And Brazilian asset yields don't compensate for crisis risk. If you already have exposure, reduce it or hedge with currency options or credit default swaps. But hedging is expensive and complex, easier to just exit. Now let's address the political question of whether Lula's spending is morally justified, even if economically risky. Lula's argument is, Brazil has massive inequality. Millions live in poverty. Social spending reduces suffering and is a moral imperative. Fiscal concerns are secondary to human needs. This is a values-based argument, and reasonable people can disagree about priorities. But the economic reality is that unsustainable spending leads to crisis, and crisis hurts the poor most. When Argentina had its crisis in 2001, poverty rates doubled. The poor lost jobs, savings, and access to services. The fiscal crisis caused more suffering than austerity would have. So even if you accept that social spending is morally necessary, doing it in an unsustainable way that leads to crisis is morally problematic because the crisis consequences are worse. The alternative is moderate, sustainable social spending combined with structural reforms that increase growth and revenue. This is harder politically, requires compromise and long-term thinking, but it's the only way to durably reduce poverty without triggering crisis. Lula's approach, expanding spending rapidly without regard for fiscal sustainability, is politically expedient, but economically and morally irresponsible because it stores up a larger crisis for later. Now let's talk about historical parallels because Brazil has been here before. In the 1980s, Brazil had a debt crisis. Inflation hit 1,000%. The currency collapsed repeatedly. They went through multiple failed stabilization plans. It took a decade to stabilize. In the 1990s, the real plan finally stabilized inflation. Fiscal responsibility was improved. Debt was brought under control. Brazil emerged as a stable investment-grade emerging market. In the early 2000s under Lula's first presidency, he maintained fiscal discipline. Despite his left-wing politics, he kept spending under control and ran primary surpluses. Markets were reassured. But in his current term, Lula has abandoned that discipline. He's governing like the fiscal rules don't apply, and Brazil is heading back toward 1980s-style crisis. The tragic irony is Lula built his reputation on responsible economic management in the 2000s. He's now destroying that legacy by reckless spending in the 2020s. Historians will debate why he changed. Is it age? Political pressure from his base? Belief that fiscal rules are neoliberal constraints that should be ignored? Whatever the reason, the consequence is the same. Brazil is heading for crisis. If this breakdown of how Brazil went from fiscal responsibility to runaway deficits, why the spending is unsustainable, what the bond market panic signals, and what crisis looks like if adjustment doesn't happen, changed how you see Brazilian investments and Latin American stability, hit that like button and subscribe. We're tracking every fiscal indicator, every bond market move, every sign that Brazil is approaching the breaking point. Leave a comment. Can Brazil avoid fiscal crisis, or is it inevitable? Is Lula's spending justified by social needs or reckless? What happens to regional stability if Brazil crashes? Share this with anyone invested in emerging markets or anyone who thinks Brazil is a safe investment. After this, they'll understand why Latin America's largest economy might be heading for its worst crisis since the 1990s, and why fiscal discipline matters even for popular presidents with good intentions.